Hello, listeners. Welcome to the Credit Compass, the podcast that helps you navigate the world of European credit. I'm Gordon Kerr, European macro strategist and host. Welcome to today's episode, where we delve into topics shaping the economic landscape of Europe and the UK. This week, we will be focusing on just one topic: energy. Prices have been rising over this winter, back to levels not seen in a while. What's driving them? How this could fuel increased inflation, and how will future geopolitical shifts, including the US's Trump presidency and Russia's changing role, impact the outlook? With me today is Karim Nassif from KBRA's Corporate and Project Finance Ratings team and specialist in European energy markets.
Hello, Gordon. Thanks for having me on.
Also joining us is Ken Egan from KBRA's Sovereign Ratings team.
Hey, Gordon.
All right, let's shed some light on this topic for our listeners. We'll start off with you, Karim. Why are energy prices rising so dramatically in Europe this year?
Thank you, Gord. I think what we can say is that in our PF&I, Project Finance and Infrastructure Outlook piece, published just at the end of last year, we did highlight that 2025 was expected to remain a volatile year for oil and gas prices, with lots of movement around the mean on specific days, weeks, and months. Now, this despite the broad theme of prices of oil, gas, and power remaining on average higher than pre-pandemic levels, and despite prices being soft relative to peaks observed at the onset of the Russia-Ukraine war in 2022. Now, it's important to distinguish between oil, gas, and power in Europe. On the gas and power side, upward pressure has come from the effects relating to cold weather, the arrangements to transfer pipeline gas from Russia via Ukraine, which have been obstructed further, and increased global competition for LNG. On the oil side, prices actually have recently fallen to as low as 70 to 72 based on, February 18, from levels of close to $79 in early January per barrel. Now, oil prices, while also exposed to similar themes as gas, such as Russian supply interruptions and sanctions, and also weather, are also being impacted by more fundamental elements to do with supply and demand, and there remains considerable supply relative to demand. And you can see this in the way that OPEC, for example, has delayed several supply cuts over the past 6 to 12 months.
Thanks for that, Karim. Now, Ken, turning to you on this topic, a rise in energy prices subsequently leads to a jump in inflation, as Europe experienced in 2022 and 2023 after Russia invaded Ukraine. So how do these higher energy prices feed into inflation, and what is the rough sort of timeline for the impact to be felt?
Yeah, I think broadly speaking, the rise in energy prices has a dual impact. There's obviously the immediate hit, higher home heating bills, for example. But then over time, there's the knock-on effect as it filters through the economy. Think about things like higher refrigeration and storage costs for restaurants, which eventually push up food prices, or fuel costs for transport and shipping, which make goods more expensive. These kind of effects take longer to show up, but they create sticky inflation that's harder to unwind. There have been studies in the past showing that, say, a 10% rise in gas prices can add around 0.2 percentage points to inflation. And lately, I'd say that relationship has become even more pronounced. Now, the ECB envisages inflation at its target level of 2% over the coming years, and markets are already pricing in more rate cuts. But the reality is, if energy prices keep rising, it's going to put that transition further down the line, delaying inflation returning to target and delaying further rate cuts. But I guess another important consideration within this discussion is how weak the underlying economy actually is.
Yeah, I mean, are all European countries really affected in the same way as a result of this?
I'd say yes and no. I mean, all countries will feel inflationary pressure from rising prices, but some are harder hit than others. On inflation, some sovereigns are in a better spot. Italy, Ireland, France, for example, all below target currently. But then others like Portugal, Belgium, and Spain are running above target, which makes energy-driven inflation a bit more of a concern. And of course, they're all under the same monetary policy umbrella, so the ECB can't tailor rates to individual countries. The UK, meanwhile, is dealing with sticky inflation, so energy price pressures are a big issue there too. Then there's energy composition. Some countries are more insulated. France with nuclear power, Spain with wind and solar, rely less on imported fossil fuels, so they have a bit more protection. On the fiscal side, a lot of countries, France, Spain, Belgium, Germany, Italy, and the UK, are already running wide fiscal deficits and still haven't fully recovered from external shocks recently. So if energy prices spike, it's much harder for them to step in and shield households and businesses. Others like Ireland, Portugal, and Greece are in better fiscal position to absorb the impact. And then on the business side, rising energy costs hurt competitiveness. That's a big problem for industrial powerhouses like Germany and Italy, where manufacturers and big industries are already struggling with weak growth.
All right, Karim, turning back to you, where does Europe get most of its energy supply from now that the taps are at least somewhat turned off from Putin's Russia?
Yeah, this depends very much country by country. The UK, for example, does source gas from Norway, the US, and Qatar, as well as from its own sources in the North Sea. Now, Norway is a very important market for Europe in general, and also Algeria is a key market as well. Some countries are more reliant, Italy, for example, on Algeria, and the mix between imports and domestic production will vary. Now, there is no doubt, however, that LNG imports from the US has been the big story in terms of replacing the lost gas imports from Russia.
Could the current US administration under President Donald Trump have an impact on European energy prices? Surely his drill baby drill mantra should bring down prices in the longer run. He has already sold India on taking on more oil.
So for European gas prices, it will be important to follow closely the LNG supply-demand balance and what all this means for LNG prices. Now, we expect Trump's policies to allow for more LNG exports from the US. This will also, by the way, coincide with more LNG supply coming from Qatar over the next 2 years or so. This is all happening while renewable energy supply is struggling actually to catch up with what is a significant increase in power demand in Europe anticipated over the next 5 years. So could the extra supply of LNG provide a type of dampening effect in terms of European gas prices? Now, this remains to be seen. It will be driven by a number of other effects as well. Some of these include economic growth in Europe, which Ken has alluded to, weather effects, rise in power demand in Europe from artificial intelligence and data centers, pace of renewable supply relative to power demand growth, and alternatives to gas as well, such as nuclear, developments with alternative fuels such as hydrogen, and the ability to store power, which could become a bigger factor in terms of addressing the issue of intermittency.
Coming back to Russia again, if there were peace, would that lower European energy prices?
It's not clear to what extent and how quickly Europe would have the desire, willingness, and/or incentive to reestablish supply routes with Russia, particularly that it has had a 2-year test period to look at alternative arrangements. And these have broadly been successful over the past 2 to 3 years. Initiatives such as the development of regas terminal capacity, greater renewable supply, and imports from alternative markets, which we've alluded to, have all helped wean Europe away from Russia. Also bear in mind the Repower EU initiative from the European Commission, which has an aim of reducing the EU's dependence on Russian fossil fuels and the transition to clean energy. Initiatives such as the Green Industrial Plan are also relevant in setting Europe on a path towards more self-sufficiency as it delivers on energy transition plans.
All right, so given all that, do you foresee energy prices coming down in the longer run, or is Europe kind of stuck with intrinsically higher energy costs?
Yeah, I think the short answer is that forecasts make it clear the energy landscape has changed and prices are likely to settle at a structurally higher level going forward than in the pre-pandemic era. For gas, long-term supply constraints across Europe, rising global competition for LNG, and the loss of Russia, the dominant supplier, are all key factors keeping prices elevated. Infrastructure and pricing dynamics also mean Europe remains exposed to volatility. Oil is a bit different, with prices more dependent on OPEC's supply decisions, but also influenced by factors like US shale production and broader geopolitical risks. Once again, the strength of the underlying economy plays a crucial role in determining long-term price trends.
Okay, so what does all this mean for credit? Is this enough to move the needle for some corporates to be challenged, or have many adjusted to the stress experienced before, and therefore are they prepared for this scenario? Doesn't this make operating in Europe a little less competitive?
I think it's early to say how long the recent spike in power and gas will continue in Europe. We certainly expect continued volatility, but wouldn't be surprised if, for example, on average across the whole of 2025, that gas and power prices actually hover at similar levels, or maybe even slightly less than where they were on average for the whole of 2024. That said, that the volatility that we're alluding to here is going to be a big challenge for merchant exposed transactions. We believe merchant exposed transactions will be tested, particularly those that have to service debt frequently on a regular quarterly basis or face default, and that do not have appropriate liquidity buffers. We expect resilience to be particularly prevalent in companies and transactions that have adequate hedges in place to deal with energy import volatility, or are able to pass these through. The converse is also true. We consider the corporate, project finance, and infrastructure market has had some experience now in dealing with periods of energy price volatility caused by multiple different events. So the well-structured, healthy credits will have inbuilt tools to deal with this volatility. This is typically associated with investment-grade credits, while the weaker credits will have more structural exposures. The continued volatility that we're expecting may actually widen the gap in terms of credit quality trajectory between IG and non-IG credits during 2025. And this will probably manifest itself in some of the default statistics that we begin to observe, particularly in the speculative space.
Thanks, Karim. From a sovereign's perspective, maybe can you add in a comment on the credit impact for sovereigns?
Yeah, sure. I mean, look, we'll continue to keep a close eye on fiscal metrics like debt ratios and deficits in this environment. As we mentioned earlier, some countries are in a more stretched position than others, and high energy prices can filter through and put pressure on these over time. So we continue to monitor developments closely.
Thank you both very much. So to sum up, energy prices are rising, at least some of them. This will likely feed into increased inflationary pressures at a time when price increases have largely been declining. And not all regions nor industries will feel the impact the same, with some more heavily hit than others, depending on how they will be impacted. Some will be more heavily impacted by rising inflation. Some are protected by their source of energy. Some are more impacted by their domestic industry makeup, and many with limited budgetary opportunities to help support and offset any large surge in pricing. Peace, or at least a ceasefire in Ukraine, will not necessarily help, as most energy consumption has committed to a migration away from Russian dependence. Nonetheless, higher energy prices will continue to challenge the competitiveness of companies within Europe as it adjusts to the new normal. Thank you very much, Karim and Ken, for your insights, and to you listeners for joining us in this review of the energy markets. Stay tuned for further updates as we continue to monitor these developments. As always, staying informed is key to navigating these complexities. Thank you for joining us on the Credit Compass. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And if you have questions or topics you'd like us to cover in future episodes, please drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.